In this video, the latest in our series on trading techniques, we're going to have a look at how to trade the news. Hello, I'm Dow Jones and this is the latest video on trading techniques that I do with Trading 212. There have been a few requests for this one, so I thought we'd put something together. And it's all about how to trade the news. When news comes out, clearly it has an impact on markets. That can be good or bad. This is a bit longer than our normal video because I think it's more of a complicated subject. You know, in the past, if we look at technical trading strategies, it's a lot more black and white. And if the price crosses above a moving average, for example, typically it's a sell signal, buy signal. If the price runs out of steam near previous highs, near resistance, it's a sell signal. That sort of stuff is much more black and white. But I think trading the news, you have to be arguably a bit more creative, but I think it's really interesting. You know, it's a really interesting subject, this, and it can give us clues. It's more about how the market reacts rather than what we think about the news. What does the wider market think? So to start things off, let's take a look at a few different scenarios. Then we'll take a look at some real markets. So let's take a look at a few scenarios. First of all, I think the straightforward ones. The market, let's pretend it's a share price or a currency, whatever it is. The market is trending higher over a certain period of time. News comes out here and the news is positive. The company has made more money, or if it's a currency, the expectation is, for example, we're going to see interest rate rises. So it's positive news and the market reacts as expected. The market pushes higher. So there we have news confirming the trend. The flip side of that, again, let's say it's a share price that's falling. Reports its results come out there. The company's lost even more money over the last 12 months, so not surprising, the share price carries on falling. So there we have just news confirming the trend again. So we'd be trading in the direction of the trend with that news. But where it gets maybe a bit more interesting, because it is all about how the market reacts, is if the market reacts a different way. Let me just take these off and look at another couple of situations. So we have a market that's moving higher. Some news comes out here. Let's say it's the pound, and some news comes out about the economy that is seen as good news. So you think, well, okay, that's the UK economy is doing well. We'd expect the pound to rally, but it does that. You know, this can be a really good sign that, well, maybe everyone was expecting the news to be good. It's not been a surprise. Maybe the news isn't as good as we thought it was going to be. So we're still a bit disappointed. So these sort of reactions to news, I think, are more interesting because maybe it starts to suggest the trend is running out of steam. So we could look at thinking, well, is sentiment changing? You know, if we see the market fall on what would, on the face of it, be good news, it can be an opportunity to maybe sell short with a relatively tight stop. We're going to look at some real examples in a minute, but just to go through the theory. And the other way around, if we see a market's falling and some news comes out here and we're expecting the news to be bad, and it does actually end up being bad. Let's say, again, it's a company that's losing money, it's a share price, and they've lost more money again, but the share price turns around. Well, again, that can be a really good signal because the market has reacted completely opposite to how maybe most people would expect. And there is a great example of this in the real world that we're going to look at in a second. So again, it can be a sign that, okay, the news is bad, but maybe in the statement they're suggesting things are going to turn around. Maybe everyone thinks the price has got as low as it's going to get. So they can be good opportunities to set up low risk. So if we're buying it and we have our stop loss down here somewhere, low risk, but potential high reward trades. So we're in at maybe near what could be a major turning point. So for me, it's when the market reaction isn't what you'd expect or what many people would expect that maybe makes for a more interesting trade. But we're going to have a look at some real examples in a minute. So the first two there were pretty straightforward. If the market's going up, good news comes out, the market carries on going up, the news is confirming the trend. So we just trade in the direction of the trend. If the market's going down, the news is bad, the market carries on going down, we trade short. But I think that the last two are maybe more interesting. You know, when the market, and we see this a lot of the time, when the market does something in reaction to the news that really we wouldn't have expected, it can be a real clue as to the next stage of market direction. But as usual, it's one thing in the real world or in the theoretical world, and it's another thing when it comes to the real world. But I've picked out 3 good examples, I think, of how news could have given us some clues and helped us to trade. So let's take a look now at the real world. So our first example of market reacting to news, I mean, clearly we're going to use historical examples here to illustrate the process, but there have been a few major news events in the last couple of years. One of the bigger ones in FX markets, particularly for the pound, of course, was the UK's decision to vote to come out of the European Union, the Brexit vote. So this is Brexit vote time, 3rd week of June, daily charts. So here's the vote. So the market was expecting everyone to vote to stay in, or the majority to vote to stay in the European Union. Clearly, when the news came out, it was a massive shock, big surprise, and negative for the pound. You know, everybody thought, well, actually, this will be negative for the pound. The market reacted as expected. Okay, so we saw massive volatility in the early hours of the morning. You know, really big move from 150 as low as, where did we go? 132. So an 1,800 point move. Absolutely massive move. But here, this is the market reacting as we would expect. Okay, so the news has been a surprise. The news would be seen as negative for the pound, and the pound has fallen. Okay, so but there are clues there, you know. So clearly, as you can see down here, once the volatility had calmed down a little bit, we still saw the pound under pressure. So the reaction to the news was as expected, and it probably should have told us that, you know, people are going to be really nervous about buying the pounds now. And we did see the market drift a bit lower into October. Okay, so we saw the pound under pressure for the next 3 to 4 months after that. What's interesting though, let's change this to a big picture. What's additionally interesting, if we look at the move since those October 2016 lows, there's been plenty of bad news about the potential for Brexit coming out. But what's the pound done? The market has rallied. So the market, broadly speaking, has moved against any negative news. So again, we could have used that actually the market feels that maybe the pound had got too low, had been beaten up too much. So even though through 2017, for example, there was lots of fairly negative outlook coming out for the pound, the market rallied. So again, it's all about how the market reacts. Let's look at a more recent and maybe slightly more dramatic, even more dramatic than this example. So we're back in 2016 again. I mean, 2016 was quite the year. It was the US presidential election, of course, in November of that year. Plenty of people thought that Hillary Clinton was going to win, that Donald Trump wasn't going to get in. And the received wisdom was if Trump got in, it'd be bad for stock markets. So overnight, with the results coming in, you know, it did see that Mr. Trump was going to be the next US president. Here's the day here. Here's the chart. Okay, it's a daily candlestick chart. So you can see in the overnight market, this is the S&P 500 we're looking at. So it's the broader US stock market index. In the overnight market, we did see this massive sell-off. The market closed at, well, about 2140 the day before, and then traded as low as 2030. So we were a 110 point move, near enough in the S&P. But by the time market started trading normally, you know, market was rallying, and the next day it pushed higher. So here's a classic example where a news event that was a surprise, that's not really that relevant, but the fact that the received wisdom was the market should move lower, the market did completely the opposite the next day. Okay, it was a one-day event, the sort of mini crash in the early hours of the morning, and the market carried on moving. And of course, you know, what's it done since then? So if you're blindly hanging on to the view that actually a Trump presidency would have been bad, immediately bad for US stocks, you know, you would have missed out on the move that started down here around about 2164, and so far has peaked up around about the 2874 level at the end of January this year. So I think a great example there where everyone thought it was a done deal that the market would just sell off in the days and the weeks to come, but it took one day to break through those previous highs and really start the rally. So a great example how the market reacts to news is more important than the news itself. For our last example, I thought we'd take a look at the most recent US non-farm payrolls, so the unemployment numbers that come out every month. So at the time of recording, these had come out the day before, the 6th of April, Friday the 6th of April. So running out, let's look at euro dollar, because clearly the dollar has, is affected by the jobs outlook in the US. This was the day before. The day before, 5th of April, the market traded as low as, 122.17, 122.17-ish. The market rallied about 40 points, then sells off again. But that level, it has a look below level, but it's a false break. This is the early hour. This is early morning. So we've still got about 3 hours until the payrolls come out. But we've got a definite level to watch here. We know that 122.17 down to 122 is good support. Let's see what happens when the payrolls come out. Let's just jump forwards. So the payrolls get announced. Just over 100,000 jobs were added in the US during March. This is against an expectation of 190,000 jobs to be added. So it really did miss expectations. And the market, the euro, rallied strongly on the news. So we saw a bounce in the euro as traders thought, well, this is bad for the US dollar. And then, as is often the case with announcements like payrolls, the market does a 180-degree flip. You have confusion when these numbers come out thinking, well, is this good or is this bad? And I think one way of trading the confusion like this is just to have a plan going in. If the market hits a certain level, you're going to buy or sell. So we'd known that 122 had been good support the previous day and the morning of the payrolls. The market sells off to the low 122s. It could be a buying opportunity to take. We're using the reaction to the news, the headless chicken reaction to the news, as a way to get into a trade at maybe a better price. As the day went on, as you often see, the market did make its mind up. There's the move. There's the craziness over the payrolls. The market did make its mind up and eventually rallied, about 60 or 70 points higher. Okay, so when news comes out and you see markets not sure, it can still be an opportunity. If you have, it worked out pretty well here because we had these definite levels. The low from the afternoon of the previous day, the low from the morning, they'd clearly been buying demand ahead of 122 and the payrolls brought it down to that level. So the market wasn't really sure for a good 20 minutes after the number came out. There was confusion until we had a definite trend, but it would have given us an opportunity to get in with, a relatively low risk level of stop loss. I really do think the best example of recent years is the US stock market reaction to the Trump win in the presidential elections at the end of 2016. Everyone thought it was received wisdom, amongst commentators, analysts, that it would be bad for the stock market, but it only lasted a day, and you can see what the market's done since then. Also, the payrolls from last Friday, the last set of non-farm payrolls that we had, you often see this confusion, this headless chicken reaction by the market, as I said, when this news comes out. And that can present opportunities. If you're disciplined and have ideas of where you want to trade going into the announcement, you can take advantage of that volatility, that uncertainty, to try and get on a low risk trade. So there's trading the news. It's really not a black and white subject, and I think anybody who says if the news says this, then do this, is talking rubbish. Because you can see there we have to be, I think, a lot more creative when it comes to trading the news. But watching how the market reacts really can give us, I think, some interesting and useful clues for future market direction. That's it for this time, so we'll start wrapping it up there. As usual, if you have a different opinion or any questions, leave us a message in the comments down below. We do read all of them. If you like the video, click on the thumbs up, and to never miss out on what we produce during the week, we look at a whole range of different markets, cryptocurrencies, more traditional markets, trading strategies, all this sort of stuff. So to make sure you're subscribed, click on the subscribe button there, and then just make sure you've clicked the alarm bell notification icon thing down there, and that way you get notified every time we upload a new video. But for this week, from me, David Jones, and Trading 212, we'll leave it there, and I hope you have a good trading week.